Morgan, we got Brian on the line. What do you want to ask him?
In terms of the market right now and the economy, what are some of those adjustments or things that you're going about to change the way that you're looking at the properties that you're going after now?
I think it's really important to dial in on your underwriting and your underwriting assumptions. So, we can see how a property is performing right now, but the real outlook is how we expect it to continue to perform and how we expect it to perform through the life of our hold.
I'm Brian Briscoe, host of the Diary of an Apartment Investor podcast. And this podcast is different than everything else out there. I bring together a new and an experienced investor on each episode, and I let the aspiring investor ask the questions that they need answered. So if you're an aspiring investor yourself, you probably will have the exact same questions. Now, before we get to this episode, make sure you hit the subscribe button below and that little bell to make sure you get notified every time we post a new episode. And now, enjoy the show. All right. Welcome to the Diary of an Apartment Investor podcast. I'm your host, Brian Briscoe, and I'm very excited for today's show. It's another one of our Ask the Expert episodes. We have two great people on the line with us today. We got Brian Wagers as our experienced investor and Morgan Jones as our aspiring investor. So welcome both of you to the show today.
Thank you. Happy to be here.
All right. And as is tradition, we're going to spotlight our experienced investor first. So, Brian, let's get to know you a little bit. So first of all, how you doing today?
Doing great. Appreciate the opportunity to be on here and with you and Morgan.
Absolutely. No problem. So do us a favor and tell us a little bit about yourself, where you've come from essentially and how you got into apartment investing as a career.
Yeah, so I got started in real estate investing about 6 years ago. Typical single family investment.
Mm-hmm.
I had that rented out. Everything was going fine. As I had it rented out, I realized it was going to be way too slow to get where I wanted to go. So I quickly pivoted to multifamily. I got a 12 unit quickly after that first one and really scaled my way up to a portfolio of about 500 units where just joint venturing, not the syndication. Syndication was always in the back of my mind, which I'm actively doing now. And then about a year and a half ago is when I really dialed in on the syndication and joint ventured with another firm, Elevate Commercial Real Estate Investment Group. And, now just syndicating deals focused on the capital raising side, whereas before I was focusing on just about every side. And now I've been involved in over 2,000 doors, on the syndication side as a general partner. Nice. So deals, I'm based here in Northwest Arkansas, but done deals in Dallas, Houston, Columbia, South Carolina. We're doing one and we're under contract in Jacksonville, Florida, San Antonio, and another one coming up in Houston.
Nice. A lot of good metros there. So, what I like to do is talk about the transition points. I mean, I think everybody gets into single family, or most people who are either on the show as guests, or I think a lot of people who are listening, single family is an easy jump. It's an easy way to get into. But let's talk about that transition from single family to that first 12 plex. First of all, you mentioned that scaling was an issue for you. That's why you went from a single family to a 12 plex. But what else was going through your mind at the time, and what were some of the biggest challenges you had making the jump from single family to 12?
Yeah, I think you hit it right there. I mean, the scalability was a big thing. It wasn't any sort of property management horror story. There was no 3 a.m. phone calls or anything like that. The resident was actually very timely with his payments and everything, but it was just, doing the backwards math of, reverse engineering where I wanted to go. And it was just going to take, what was I able to get? I was going to maybe do one rental property a year, and, all the funds usually had to come from myself, that in the single family space. So I knew in syndication, I could start raising capital outside of my own funds and get more people involved. So that was one token of it. And just the ability to eventually hire out property management company. I know I didn't have any problems at the time, but that's not something I saw myself drawing up leases for hundreds of people, in the future. And I knew that the apartment space, these apartments paid for itself to have that professional property management. So that was in the back of my mind as well.
Yeah. That's one thing that's nice about when you get into larger apartments is when you're looking at the underwriting, when you're looking at the analysis, the cash flow has the management fee built in already. And it's like, it's assumed that you're going to have the management there. And so all the pricing's based off of having management, so that's one thing that I've always appreciated about multifamily myself. But so just a couple of commonalities there. I started with single family as well. And I remember spreadsheeting it, myself and looking at how long is it going to take me to get from where I'm at to, where I want to go. And I hit the same hurdle you did. It was essentially, I figured that if I really hustled, I could buy 2 a year, but it was still going to take me like 25 to 30 years to be, financially free, in air quotes. But so that's same reason I turned this direction. Now, something else you mentioned in your introduction is you did the first several using, joint ventures. And then it took you a little longer to get into the syndication model. Let's talk about that transition as well. Why did you do joint ventures at first? And why did you end up transitioning to syndications there?
Yeah, so I knew I wanted to do multifamily, and I started to go. I think for me, I just started, after that first 12 unit, I really had good success in the small, medium-sized apartment complexes. So, I didn't feel the need to really have to go larger, and I don't think maybe I was comfortable with the model of the larger units at the time. So. For me, it was just the access to deals that I had. I was getting deals sent that were in this, under 100 unit, under the radar probably of the larger firms at the time. This was 4 or 5 years ago, where, there may have not been as many eyes on the smaller units. And I think maybe it was a level of comfort. I felt with the smaller, medium size. So that 12 unit, I just did a promissory note from a family friend, where they gave me $100,000 loan. I told them I'd pay them back $125,000, and that was it. They're used to having, their money in the stock market. So I just kept it as simple as possible. And then once I started doing the joint ventures, now I'm doing these waterfalls and, different models for syndications. But at the time I was just trying to keep it as simple as possible and really hone in on my advantage. And that was, I was local in my market, and I was getting deals sent to me by the commercial brokers that I had started to develop relationships with.
Mm-hmm. Nice. And I think everybody, I'm not going to say a blanket statement, I'll make a blanket statement. So inherently it's going to be false, but, almost everybody goes in, I think, with something similar where it's hard. It was hard for me anyway to wrap my head around doing these 100+ unit deals. It was hard for me to imagine a path going from 1 to 100 without hitting the 12s and the 20s first. And that's actually the route that I ended up going. And I would say in a similar vein that, we stayed in the double figure, unit counts for a long time because, part of it was that mental shift you've got to take to be able to actually tackle those deals and get up to that level. So, that said, right now you say you're with Elevate. How did that come about for you?
Yeah. So I guess about a year and a half ago, I talk a little bit about, what I was doing was working, and I was getting deals sent to me, good deals. And I had property management companies set up that I used for one market that I was in, and then another property management company for a different market. So there was only really 2 markets that I was in that are neighboring in my backyard. And I mean, I was starting to get some of the same deals sent to me that I had already looked at years past. So I knew that, there was an inventory problem. One, I'm in Arkansas, Northwest Arkansas. There's only so many doors here. So, I started to come across some of the same deals. And I was starting to get more priced out on deals. I was starting to get some of the deals that it was a lot less deals I would go through that I would actually look at. And, so I knew going in, I had syndication in the back of my mind. And so right around that time, these things were happening. So I knew that, okay, I'm going to have to make a pivot to this syndication space if I want to continue to grow. These deals are not making as much sense. They're slowing down quite a bit.
Yeah.
So I was going to have to probably look outside of my own market and try to figure out a way that I could bring value outside of my market where I'm not necessarily boots on the ground. And for me, that was something that I wanted to do. Maybe I could have chose maybe to underwrite deals or do some other aspects, or maybe a little bit of asset management oversight. But for me, I really liked the capital raising piece that I had started to grow. When I was growing these family and friends money, I started to like that. So I raised capital as a co-sponsor, co-GP with Elevate on a couple of deals. I had reached out to George, and we actually met in person at an event. And, so I just raised for them for about 2 or 3 deals on just kind of one-off deals. And I really liked the process, really liked the vertical integration of the in-house construction team. That was really important to me going into these other markets. I would want something that could I did due diligence on these smaller units, but we're talking about 400 unit apartment complexes. I would be pretty scared that I would oversee, if someone might see I could see a foundational issue if there's cracks in the walls or something like that. Sure. Yeah, I would know that, but I would want another set of eyes to pick up stuff that I wouldn't see that could be, hundreds of thousands of dollars, even $1 million problem. Yeah. So finding someone that was experienced in that side of the business and really honing in on the capital raising side of the piece was, a good fit for me, and finding a growing company that was somewhere in that need. So I raised on a couple deals for them, 3 or 4 deals, and everything was really good. Obviously some roadblocks throughout, but we were able to handle those, and the communication went well. So just found a need with them, and we eventually partnered up just a couple months ago. So where I'm only raising for their deals, and now I'm overseeing the equity stack on with their portfolio. And even now I'm working with other co-raisers like I was myself. So sometimes we'll bring in outside capital raisers for the larger deals where we might need some extra capital. So now it's full circle. I'm working with some of the same people that that I was considering myself as a co-sponsor.
Nice. Interesting how that works. So, just to sum things up, with Elevate, at least you came in as a co-GP raising capital, did that several times, were invited to be part of the team, and now you're managing the capital side of Elevate. So working with other co-GPs as needed, and raising capital for groups for your current deals, correct?
Yeah, exactly. And I wasn't necessarily invited to take that. I pushed to make. I was like, hey, bring me out. Like I wanted to over deliver on all these different capital raises, and I was the one that was, hey, I think this is something that you guys could need. You have your co Eric and George are the leads, and that's something I thought that they could use help on if they wanted to continue to do these other deals. So I made the push for them to bring me on, full time with just Elevate, strictly on Elevate, and be more aligned. And, as I did that, then they also hired asset manager and acquisitions director too, for some of that underwriting and doing more deals. So it's becoming more vertically streamed, but yeah.
All right. And I've met most people at Elevate. I saw George at a conference a couple of weeks ago. Were you at Dealmaker Live too, by chance?
Yeah, I think I saw you running around there. Somewhere, I don't know. I was only there for a day.
I was only there for a day too, so I didn't get to talk to as nearly as many people as I wanted to. And it's always the nature of those conferences, is you walk away and you're like, man, I wish I would have talked to a whole list of people, but I had a chance to shake George's hand, and that was it. So but anyway, well, hey, great, exciting story there. Glad you got yourself into it, and I think that's a good recipe for success. You come in, you Under promise, over deliver. You provide value, and convince people that they need you. And a company that's scaling like Elevate is, or trying to scale, there's two things that they're looking for. They're looking for deals. They're looking for money. And if you can come in and provide one or the other, I mean, bam, there's definitely a need for that. And you built the relationship and were able to carve out a niche for yourself. So,
Exactly.
So let's shift focus a little bit. One thing I'd like to ask everybody on the show is, about their motivation for success. And so, question for you is, what is your why?
Yeah, I mean, I think there's a bunch of different whys, and I think there's whys change, but I think, being able to provide for myself, my current family, and my future family. I don't have any kids yet, but I'm more recently married, and I know that there'll be kids in my future, and I want to be able to give them as many resources as they can have. And that I didn't necessarily have. I had a lot of love and support, but I didn't necessarily have any financial resources. So that's something I want to be able to provide for my future family. I want to be able to be there for my family. I don't want to have to worry about not being there. So I think that's kind of the goal. Once they get to that active age, that's a big why for me. Once my future kids are 6 or 7, I want to be able to attend all their sports games, or whatever they decide to be active in, be there for them. And then eventually I'd like to get back to like some young entrepreneur foundations, and give back to my high school a little bit too. Those are kind of some whys for me.
Yeah, I like it. And as a guy that's had 5-6-year-olds now, I'll tell you, the last year I spent a lot of time on basketball courts and parks and in gymnasiums in general. So this definitely gives you the ability to do that. And I think a lot of people realize that. I coached 2 basketball teams. I take my kids to gymnastics. And a lot of things that I wasn't able to do when I had a W-2 are now, the norm for us, which is really, really nice. So yeah, I love your why. It's very much in line with why I'm doing what I'm doing too. So let's do a real quick discussion of kind of one of the projects or deals that you've been involved with. So pick your first or your favorite, and let's dive in a little bit.
Yeah, so I guess one of our more recent ones I could look at would be our one in Mesquite, Texas. We just closed on that earlier this year. It was a 190 unit in Mesquite, Texas. We were able to get that for 17 million.
Now, where is Mesquite, Texas? That's not one that I'm familiar with.
Just outside of Dallas. It's a Dallas MSA, so it's northeast of Dallas.
Got it.
So right on the path of progress. Dallas is pushing north, and it's pushing northeast. So it's right where all of Dallas can only contain so much. So we are looking at more and more of this, Aubrey, Weatherford, some of these markets right around inside the Dallas MSA.
Okay. So you got the property at 17 million, and sorry, go from there.
Yeah, 17 million. It's kind of your classic value add deals, C-class, C-class property right on the border of a C to B area. So, love the opportunity to bring a C closer to the B and a market like that, where the neighborhood supports it. Built in 1960 or 1959, so a little on the more older side than what we usually look at, but property was really well kept. Obviously, we checked the foundation and did our due diligence there, so no issues. About $2.5 million capital expenditures. So a lot of that will be going to a little bit about 500 to 700,000 going to the exteriors, doing a little bit of rebranding there, some new paint work, adding in a playground at the facility, and then a lot of it's going to go to the interiors. A lot of classic vintage interiors so that we can really bring those up to market.
Interesting. Now with late 50s vintage, I mean, I've been part of GP on several that are newer and several that are older. Seems the plumbing, is always the biggest wild card when you get into the really, really old buildings. So I know, George also is, big into he's a general contractor and has the construction company. I'm sure that helped a lot with the due diligence as well. But
yeah, I didn't know that you're supposed to scope soon. Like when we're doing the smaller medium, I didn't know, scoping lines was a thing, when I did the smaller apartments, but that is definitely important on every purchase you make, especially like you mentioned some of the older ones, to really get in there and scope the lines. On
a couple of our early purchases, we did not scope lines, and we have had to replace, lines before, and it's about a $30,000 bill because you got to bring the backhoe in and dig it up. And, once you replace the line, you got to fill it back in and redo all the landscaping. And yeah, when all said and done, it's worth a couple $100 to get the plumber out there just to scope the line. And that way you can at least plan for it and, potentially do a retrade if you have to. But so with the older properties, like I say, plumbing seems to be the biggest wild card that we've seen. And we don't have any 50s vintage. We have 30s, 40s, and 60s, but we skipped over the 50s generation. But
you had nailed it on we had a sewer line bust right before I sold one of the joint ventures. So I exited on one of those joint ventures, and we had one, and it was a $33,000 bill.
Yep.
It was like right there.
Yeah, that's ballpark where it's at, so not something that you want to. It's something that's, like I said, worth a couple $100 to pay a plumber to scope the lines, so it's coming down the pipe. Funny pun intended, I guess. Know it's coming down the pipe. All right. But anyway, that said, love the idea. And something else that I'll point out that I think people don't realize is you talked about the exterior first. It sounds like you have kind of an outside in approach, which I'm a huge fan of. I think up front, when I started the business, I was looking at interiors first and then exteriors if we have money left over. But I think the right way to do things is the opposite. You put the playground in, you make the pool look nice, you invest in landscaping and trim work and whatnot, and you make the place look nicer, and then you can attract a higher quality tenants. That's the first thing they see. But anyway, that said, what's next for you?
Yeah, so I briefly skimmed on it. We have a couple deals under contract right now. A couple of them are fully subscribed. We are still raising. We're about to launch the one in La Porte, Texas, A-class deal. Just over 300 units there. So that's an asset class that we're looking more and more at too, is the A-class, when we can buy from the developer. If we're in the next position after the developer and we can continue the lease up process, where 4 or 5 years ago, you asked me, I probably would have told you I'll never do an A-class deal, only value add apartment complexes. But that's an asset class that we're looking at. Obviously, Elevate's based in Dallas, but we're looking more and more at other markets, Nashville, some stuff in the Midwest like Cincy, Louisville, Lexington. Now that we brought this asset manager on full time and really have grown our team, also realize the value and having other partners. Where partners might bring us a deal, or like I mentioned before, bring in capital, we're able to, get more deals in different states. So really open on high growth markets. We're really looking at 150 units to 1,000 units, C plus to A plus assets.
Nice. Yeah, I think the economy's changed. The nature of the game has changed slightly in the last couple of years, where a lot of C-class value add investors are doing the same thing. Same pivot. There's been a compression between the spread or the gap between what A-class cap rates are and C-class cap rates have narrowed to where you can almost make the same returns with A class without the C class problems, but it's one thing I've noticed is if you buy C class properties, you have C class problems, and that involves a lot of sewers and a lot of tenant issues. But anyway, that said, we're going to shift gears a little bit and bring Morgan on. So Morgan, welcome to the show today.
Hi, Brian. Thank you for having me today.
Yeah, no problem. Glad to finally get you on. Your work schedules, I understand very much. You're a first lieutenant in the Army, if I'm not mistaken, correct?
Yes, that is correct.
Yep. And I've been a first lieutenant in the Marine Corps before, and I know that you don't own your time. So thanks very much for taking the time to come on the show today.
Thank you once again for having me. Super excited to be here.
Awesome. So let's talk about you. Tell us about yourself.
Okay. So I was actually born in Greenwood, South Carolina. So I know a little bit about South Carolina. Brian mentioned Columbia. So that's super exciting. But I grew up here in Stockbridge, Georgia. Played basketball majority of my life. And I actually was able to receive a full ride to North Carolina Central University. So I went to school out there. Got both my bachelor's and master's from there. And when I graduated, I said, okay, well, what's next? Started reading a lot of books, and of course, Rich Dad Poor Dad Cross. He talks about real estate, and from there, I knew that was definitely something that I wanted to do. Growing up, seeing my parents, they own several properties. Our job was to go in and actually clean the properties, and we would get paid for it. So kind of seeing it from the residential side, through my reading, learning a lot more about multifamily. I knew that's where I wanted to start as opposed to starting with single family homes. And so I joined a mentorship program and met my team there, Fortune for Generations Capital Partners. And we're actively working to get our first deal.
Nice. And I would say, Brian, I think she's smarter than both of us because she's skipping single family and going straight to multifamily. So good for you. Yeah. Well, that's awesome. And I love how, up front you were working on properties from the cleaning aspect. And, I've got my kids occasionally doing age appropriate activities to help me run the business. I've got an 11-year-old that does a lot of VA type activities for me. So it's fun to get the kids involved, and fun to hear that you were involved in similar stuff as a kid yourself. So anyway, that said, what's your big motivation? What's your big burning why for this?
I would definitely say, like most, financial freedom, location freedom, just being able to do what you want when you want. But even to touch on more of my family, I have a younger sister, love her to death, and just want to be a role model for her. I have two other siblings as well, but just being that person in my family to change the course of where we're going. I want to be able to travel with them and do those type of things.
Nice, very, very nice. I think a lot of people have similar. For most people on the show, I think it's about family. One way or another, it's always about family and taking care of the people that you love the most. But anyway, thanks for sharing that and your experience, and also thank you very much for your military service. And from one vet to another, thank you very much. So that part of my life's over, and happy to have good people like you carrying the torch for a little bit. But anyway, that said, Morgan, we got Brian on the line. What do you want to ask him?
Hi, Brian. Thanks again for being here. Just sharing your expertise. You guys kind of touched on it a little bit, but one of my questions is, in terms of the market right now and the economy, what are some of those adjustments or, things that you're going about to change the way that you're looking at the properties that you're going after now?
Yeah, that's a good question. And thank you for your service. Definitely appreciate that. So the economy is definitely something you want to have a pulse on, especially now, as, we are looking at a possible recession. You also have interest rates being hiked. So I think it's really important to dial in on your underwriting and your underwriting assumptions. So, we can see how a property is performing right now, but the real outlook is how we expect it to continue to perform and how we expect it to perform through the life of our hold. So, typically we're projecting 5-year holds. So, making sure we're being conservative and rent bumps, rents may or may not increase the same trajectory they have the past 5 years as they will the next 5 years, if we do have a recession. I personally think if we have a recession, it'll be a lot more mild than some of the headlines are saying. I think it'll be maybe a shorter 6 to 12 month cool down. But at the same token, that can definitely affect your returns if depending on how you're underwriting and when you plan on exiting. But I think it's important to make sure you're underwriting for higher cap rates. So when you're modeling it out, when you're going in and you're looking at your underwriting model, make sure that your cap rate when you're selling is higher than when you are buying. So depending on your market, 1.5 points higher than what you're buying at. As to be careful of saying a blanket statement, I would say that's a pretty good general rule of thumb. But I would get with someone that's actively doing deals and kind of look at their underwriting. Maybe look at, there's a lot of offerings out there. So you could dial in on some of those underwriting assumptions and see how other people are underwriting their deals right now. So, we're accounting for higher insurance and higher taxes, higher cap rates, and then just being conservative with those rent growths.
Yeah, I think the biggest thing is, I mean, the insurance cost, like Brian said, are things that are a lot higher. Taxes across the nation and some states in particular. I know you're in Texas a lot, but Texas taxes I hear have, gone up significantly over the last couple of years. But there's a lot of higher expense line items, and then the future is not going to be as rosy as it has been the last 5 years. So I think really you just have to be very careful and stick to the fundamentals. Going in. What's fundamentally going to make this property worth more in 3 to 5 years. And the other thing is, debt is a really big issue right now. I mean, as the date of recording, just 3-4 days ago, the Fed brought interest rates up by, 75 basis points, so your debt's going to be higher than normal. So really it's just right now, I think you just have to be extremely careful on what you're doing. But on the flip side, I think if you're syndicating, especially if you're syndicating, you need to start broadcasting the narrative of it's a different market and higher, mid to upper teens as far as IRRs are not necessarily going to be the rule in the next couple of years. I think right now the key words are going to be, capital preservation instead of growth. We can give you a hedge. We can help you preserve some of your capital and take some of your capital out of the stock market that has lost about 25% of its value in the first 6 months of the year. So I think that's really part of it too. Be more careful on the deals you get in and be honest with your investors and what the expectations should be and paint that picture for them.
That's great. So my next question is, what are some of the things that you know now that you wish you would have, it would have been brought up a lot more in the beginning? That kind of might, it's really important that, you might have passed over, wasn't brought up as much in the beginning.
Yeah, I think, for me, it was probably going larger with the larger deals. I think for me personally, I was kind of stuck in the small, medium size. I didn't think I was stuck, necessarily, but just being open to some of these larger deals early on, knowing that I could team up, knowing that it's okay to give up a size of the pie. I was 100% of the GP for the couple hundreds of units, but now a smaller percentage of the GP, but we're looking at thousands and thousands of doors. So I think, and at the same token, you can kind of hone in on what you like about doing. You talk about doing what you want with who you want when you want. I think especially on the capital raising side, you can pretty much be anywhere. I mean, even with the acquisition side, you can fly around the country looking at different deals and talking to brokers. So I think the scalability really lets you be more flexible with your terms. So I think for me, it's probably, going bigger sooner would probably be something that I would have thought of earlier.
Yeah. And I'm going to say the same thing from a different direction, is going bigger sooner. We spent a lot of time in tertiary markets, and I was listening to a book that, the former President Trump wrote, back in the, I think, late 80s, early 90s. And he made a point that if you buy the best building in the best block in the best neighborhood in the best cities, you're always going to be able to sell. There's always going to be competition, and it's always healthy. We took the opposite approach. I mean, trying to make a name for ourselves. I think there's a good reason to jump into tertiary markets when you're trying to get your first deal, because there's not a lot of competition. But I would, if I were to go back and look at our acquisitions, I would have jumped into the secondary and primary markets a lot faster, instead of staying in, and you're from Greenwood, so some of the towns that we're in. We're in Pickens, we're in central South Carolina, we're in Spartanburg, we got one in Columbia too, and in Augusta, but Augusta is the largest metro we have a property in, and it's actually Columbia is bigger than Augusta. Sorry, so Columbia is the biggest metro we have a property in, and Columbia is about 800,000. So I think I would have flipped and gone towards the larger metros earlier, because later on when you're trying to sell them, there's going to be a lot more buyers lined up for that.
Yeah, it's like taking a plane off. You're getting the wind behind it. It's a lot easier to take off, with the wind behind you when you're in those larger deals and larger markets.
Yep. Yeah, they are easier to sell, and that's the thing we're looking at right now as we're trying to sell a lot of our portfolio. Had we been in Atlanta instead of Pickens, we'd probably have multiple offers on a property, and it's you got to look at the exit as well, and that's something I think that we didn't do as well as we could have, was assuming that would be able to exit as easy as we were to buy. So
okay, yeah, no, that's great. And my final question is, what is a mistake that you learned from? I think we can learn a lot from our mistakes, and you guys are leading the way in terms of that. Can help us and help me and my team get better, to kind of navigate some of those things.
Yeah, so I guess one of my early mistakes was I actually over renovated one of my smaller deals. So I put it, the parking lot needed to be redone, and I've got like 6-inch graded concrete. I brought the nicest product out there that you could put in there. I spent like $30,000 or $50,000 on a $400,000 to $500,000 apartment complex, just because I knew in my mind the parking lot's going to last a long time. But when I did that, I ran out of some of the money that I wanted to spend on more of the interiors and the exteriors. So something I didn't do, part of what makes you successful though is it's taking action and just doing things. But sometimes you want to consult with people that are in the space and maybe your partner. So something I didn't do was ask the property management company, hey, here's my budget for, what I plan on doing with this apartment. What do you think will get the highest and best use of this? So I definitely could have consulted with a property management company, and they may have said, let's just go with some, a different type of parking lot. We can just put it, just repave it and restripe it, and we'll have more money for interiors. You're getting a lot better. You'll probably get higher rents if you put your money in this part of the property. So the one thing I wish I would have done there is consult with a property management company, and and at that maybe consult with a couple of different property management companies to get different opinions on that.
Yeah, I like it, and we've made similar mistakes on a couple of things, but I'll just add is I think one of the biggest mistakes I had was assuming that the asset management part would be easy. A lot of coaching programs, and I was in a coaching program. My partners, a couple of my partners were in coaching programs as well, and most of the coaching programs focus on acquisitions and getting that first deal and getting to the finish line, but I just made the assumption that the asset management on the back end was was going to be easy. Otherwise, more people would focus on it, but there's not a lot out there on it. And it ended up being a little more difficult than I imagined. And I found out that asset management is something that I'm not necessarily good at. So what took me a while to do is figure out that, I'm going, the Brian Wagers route, where I'm raising capital for other people. I'm finding people that are good at that and being able to bring money to other people right now. And anyway, that was probably one of the biggest mistakes I made, was just assuming that we'd be able to figure it out.
Yeah, it's a good point. Yeah, just because you have property management doesn't mean it's completely hands off. Yeah, right. You definitely want to make sure you're reviewing their reports and reviewing what they're sending you, and making sure you're managing the managers. Yeah,
and we've had poor luck with property managers, and once again, this is kind of the nature of these tertiary markets where our managers weren't managing it well. And part of looking back at it, in hindsight's 2020, part of the reason we've had a hard devil of a time getting good property managers is because we've got a lot of properties that are out in the sticks, and overall they're going to perform well. Overall, they're going to give, really solid returns to our investors. But they ended up being headaches for us while we were managing it. But anyway, that said, we are about out of time. So one question for each of you to wrap things up. Brian, you get to go first. How can listeners learn more about you?
Yeah, I'm on social media, pretty active on social media. So LinkedIn, Instagram, Facebook, just my name, Brian Wagers. Or if you have any questions, you can shoot me an email, brian@elevatecig.com.
All right. And we'll make sure that information hits the show notes for anybody who's interested. Just check out those show notes. And Morgan, same question for you. How can listeners learn more about you?
So you can find my team on Instagram at Fortune, 4 Generations, and also on LinkedIn at FFG Capital Partners. And we'll be happy and willing to answer any questions you guys have, but also we'll be reaching out to a lot of you guys as well.
All right. Thank you very much. Thanks to both of you for being on the show today. I very much appreciate it, and look forward to talking again soon.
Thank you, Brian.
Thanks, guys.
Hey, if you like that episode, make sure you hit that subscribe button. But more importantly, if you haven't joined our multifamily educational community, the Tribe of Titans, yet, you are missing out. So get yourself 30 days free by clicking the link below in the description, or go to thetribeoftitans.info, and we'll see you there.